say identification and, Ronnie, can I get you to lead us in our invocation? We'll call our meeting to order if you'll lead us in our invocation, and we'll have our pledge of allegiance to the flag.
Okay. We met, I met with, Becky and Danny and Kimberly. We had a couple of meetings and we had some conversations and, so the process has, been long and you'll see a little bit difficult. So, what I'm gonna do is I'm gonna walk through the initial budget that we, and the results of the budget as we went through line item. And, we'll look at, we do have a very significant deficit in the, water department. We're going to walk through a recommendation. I'm going to walk through how the deficit occurred or how we overlooked, and actually, there were some mistakes in the bond issuance that we're going to look at. So I know everybody's going to have some comments, but if you'll kind of keep your questions, and let's walk through it, and then, we can open it up, and I'll try to answer as many of the questions as I can and give you as much background as we all recall. So we're going to start. The process is pretty, as far as going through the budget, it's, we're looking at, this second column. We're gonna be looking at this column, which is the preliminary budget. And once we walked through that, we saw the issue. The water revenue, pretty easy. We're budgeting basically the same as we have. Your water revenue and your sewer revenue and your fees have been consistent over the last 4 or 5 years. So your water revenue is, this is your budget, this last column. Right, this is projected actual, so this is the budget that we're looking at. So your water revenue, we're budgeting 165. That's the same amount we've budgeted for several years, and it's been, pretty much right on. We are budgeting $14,000 for fees, and we're budgeting $150 for the sewer revenue. So overall, we have $329,000 budgeted. Pretty straightforward. But then we get into the expense side. We originally had smoke testing, but TCEQ came back and they apparently dropped the city from the program, so the requirement's not there. So we took the $25,000 out that we originally budgeted. Okay, this $132,650, that's the average debt service for the bond. That's interest and principal. We're budgeting the whole amount. What you will see at the end of the year on the financial statements is the principal part, which is $75,000, will not show up on your profit and loss, so you'll actually see a decrease in your net income. But for budget purposes, we're budgeting the whole amount, principal and interest, so that we know that we have revenue to cover it. Same thing on the next line, which is your water meter payment. This $23,984 is the Badger meter system. It's a 10-year note payable. Most of that, if not all of it, is principal. So again, at the end of the year, when we adjusted for your financial statements, most of this will be come off your profit and loss, and there will be a decrease in your notes payable, which is a liability on your balance sheet. The next budgeted item is accounting services. We put in a 3% cost of living increase. So the next these two items, they're halved between the water and the general fund. So $57.50 we're budgeting for our accounting services, $62.50 for the audit. You have bank service charges of $500. You have billing expense, $500. I think that's like the cards and things. This next one is new. It says billing sewer expense. This is an estimate of what the city is going to pay Beaumont in lieu of the sewer system, right? Okay. And it's based on, we had 1 full month that we were able to project using that, so 168. Okay, the next two items are contract labor. You have your meter reading and contract labor other. This is, who's the contractor? It used to be utility specialist. Is it still utility? Yeah. Okay. This is a decrease from the prior year because some of that labor is going away because of the contract with the city. But they're still going to read the meters, and there's still going to be some responsibilities that the city has for the water plant and sewer. So it's $7,200 and $28,200. I think Danny got that from the company.
Let me add something. The $7,200 for the meter reading, that's not for the people, that's not for labor to go out and read it.
No,
that's what we pay Badger each month. That's what the yearly amount is for their cellular system. And then the other figure, $28,200, was $45,000, but now it's reduced since the sewer plant's gone away, but they still have 4 lift stations that they have to maintain throughout the city, so that's why it didn't cut exactly in half.
Okay, we have $500 for diesel. We have $750 for dues and subscriptions. We have $25,000 for electricity, and this went down. We're projecting this going down about $10,000 because some of that's going away. We have engineering services of $2,500, ground maintenance of $7,000, insurance which decreased because some of it's going away to $8,000. Lab tests decreased from projected $12,000 to $4,000. Legal services, we lowered it to $2,500. The next section is your maintenance and materials. And again, you still will have some responsibilities for maintenance and repairs. You have your turn on, turn off expense of $4,000. We increased that a little bit based on what you actually incurred during the year, or year to date. Materials, $5,000, and maintenance and repairs, $37,500. You might not be able to see the bottom too well, but the next one is office. is $3,800, and postage is $2,800. If I can do this right. Oh, yeah. Okay, so we have payroll taxes, $2,200. Your permit assessment fee is $1,250. That'll go down by about half. Your phone is $2,000. Sludge removal goes away, so we didn't budget for that. Tools and equipment, $500, and wages on the city side, on the water side of $26,000. So our total expenses, including operating and debt service, is $508,334, which leaves the city, the water, with a deficit, a budgeted deficit of $179,334. Which is not sustainable and unexpected, based on what we had looked at while we were looking at actually going through the bond. So I'm going to your next handout is a recommendation. The recommendation that is a consensus of what needs to happen. And again, I will tell you why we got to this point.
Are we gonna go over these numbers that you just went over before we go to something else?
I think we can. We've looked at them several times and made some changes. If you have a question on one,
Yeah.
we can do that now before we move on.
Okay, down here on maintenance and repairs, it went up, nearly $10,000.
Okay, is that down on the bottom?
Yeah,
Okay, Dan, you might have to step in.
well, what?
It's 37.5 is what.
Right.
There is actually a decrease from the 68,000 we budgeted in the prior year. There is a decrease overall because the sewer is going away. And so if you look on the last year's budget, which is the second column, this may explain some of it. But some of it's just moving it around. You see on the top line, we budgeted in the prior year $30,000 for other, which was labor when they came out. When the city had to call them, and it was outside the contracted amount. And so instead of having maintenance and repairs and then other maintenance, we actually didn't budget for other. We just said we're going to put everything in repairs and maintenance. And so the 30,000, part of that 30,000 that was in other that we budgeted in prior years is the 7,500 over that what we've always budgeted for maintenance and repairs.
Including the reduction for the sewer plant.
Right.
So where that was 60,000 before,
Yeah.
it's actually 37.
Yeah, so we went from 4 line items to 3, which includes the reduction, and we're just added the other maintenance that we had been accounting for in this other line. We're just going to put it all in repairs and maintenance. There's no need to separate it. We had that discussion. Does that help you on that?
Kinda, I just had thought that most of the, maintenance and repairs was actually on the sewer plant itself.
No, I think y'all have water, y'all have lines, y'all have leaks. I mean, we can do line item. I don't know the breakdown, but
Kim,
it's not all gonna go away.
if you had to guess on a monthly bill from Utility Specialties, probably 75% of it, as a guess, is due to water problems and not sewer problems, is that right? Water lines and water-related things, that's right, that's why it came down so much with the sewer plant going away, because there was a lot of maintenance-related stuff now that has been loaded up on a trailer and is being hauled out daily.
So all that maintenance repairs is not gonna go away, it's related to water. So, any other?
And one other clarification, someplace else where we had, here it is right here, where we got contract labor other, that 28,200, that's just their fee for maintaining the water plant, checking it one hour a day, 7 days a week, 24/7, 365. That figure has no money in it for any repairs or maintenance of whatever. That's just the fee we pay them for looking after our stuff. All the repairs that they do now show up in this line item, maintenance repairs of $37,500. Now, later on, she'll probably get to, well, we may not get to it because it doesn't show up, but some of that money actually comes back to us because somebody, for instance, somebody will call up and say, hey, I got a leak out here, send somebody out. Kimberly will say, well, if it's on your side, you're gonna have to pay for it, or you can get a plumber to go say, yeah, I don't care, I don't have a plumber, send them out here. We send them out there, and probably 60 or 70% of the time, the leak is on their side, so they get charged whatever we get charged, and that doesn't show right there, but
No.
it is up in the
It's in the
very top
revenue.
in that 329 in total income. That's where it goes back to. So that's a little misleading, but anyway, there's an explanation for that.
Yeah. I'm sorry, yes,
Because I know we've got to talk about where we're gonna make that deficit that we did not anticipate. Is there any particular spot or area or any particular expense that contributed to that deficiency? So, because I know people are gonna ask that question, why are we having to make adjustments? Okay,
it's debt service. It's
Okay.
your debt service. See, but because we are budgeting, if you go back to your page 1, we are actually budgeting the full debt service.
Okay.
So this and this is, and I appreciate the question because when I was thinking about this earlier, in the 179 deficit, it's actually a twofold issue. And we have to look at it in two aspects. You have the 156,000 of that 179,000 deficit is your debt service. So when we know that's the biggest issue. But if you take if we're gonna take into account the 155, you're still about somewhere between 23 and 25% $1,000 short just operating. And if you look at last year's budget, the one you're in right now, we actually budgeted to have a deficit of 33,000. So you have potentially 2 years where you're running just operating at deficits, which tells me either y'all aren't managing your expenditures or you're not bringing in enough just revenue. So when we're looking at the 179,000 deficit, we have to look at it in two parts, okay? Yes, we have the debt service, but are we generating enough operating revenue, even if we didn't have the debt, or to just maintain and plan for the future? Because this year, we're using, because that's pretty much where we're at actual, as far as cash flow wise, we are using some of your fund balance. And we have, in the water side, there, based on the last year's year end, there is about $167,000. Sure I get it right. I think it's $160,000 in unrestricted net assets, which means it's available for anything. But we are actually, depending on how you come out actual this year, at the end of this year, we're gonna be using some of that to fund the shortfall in your water side. And we knew that going into this year. Can't do that every year though. So you have to start generating some net income so that you can build your unrestricted fund balance back up. And it's been the city's actually been eating at it a little bit, not every year, but more years out of not the last 5 or 6 years, we've always kind of had a little shortfall. So I just want to make sure you understand, this is not just a debt service issue. This is not just trying to find money to pay your debt. It's trying to make sure you have enough operating income, net income, to plan to get you through the whole year on a positive note, but also to build your fund balance for, an emergency fund, disaster recovery, an operating, you should have 3 to 6 months in your operating fund. Well, not there. So now we're back to why do we have $179,000 deficit?
That's a lot of money too.
Yes. Okay, so in your packet, let me see what's next. Okay, so this is the recommendation. This is the recommendation that we, after discussion and looking at the numbers, that this is the best option to alleviate it. And like I said, I'm gonna put it out there, and then I'm gonna show you how we got there. Just needs to, just so everybody's on the same page. Okay, so your debt service in total for the next till 2024 is $156,650, or around that. I mean, it's a rounded number, but what that is the $132,000. That's your bond, and then the $24,000, which is the Badger meter, which gets paid off in 2024. I think is the last year. So after that, you have 10 more years of just the bond at $132,000 average. Okay, so we looked at how do you cover that? How do you cover your debt service? And apparently this has happened in the past, many years ago, where a bond was taken out and there was a monthly fee assessed for the life of that bond or for a certain period of time. And at that, way back when, I don't know, I think it was in the 80s or something, it was $25 a month per connection, I believe is what it was. So we're approaching it about kind of the same. We're basing it on 550 connections, which you actually, I think, have billable 559. I mean, there's 569 connections, but I think some of them are city, some of them are the ESD where they don't get paid. But anyway, so conservative estimate is 550. So if you just take the 550, you take your total debt, you divide it by 550, you round it. We're getting to this $23.50 a month per connection, and that will generate about $155,000, which will pretty much cover your total debt service through 24 with the recommendation that it be reevaluated at least prior to 2025, because it can go down. Now, this, the 2350 or the 155,000 that you generate, that fee is totally restricted for debt service. So, say your connections are actually, 569, and you generate, whatever that is, say it's 160,000. You pay off your debt for that year, the remainder of that fee, you can't use it for operating. It goes into an account, it goes into a debt service account, and it's reserved for the next year. So you could possibly, end up building some residual that carries over that will maybe alleviate or speed up the possibility of lowering that monthly fee at some point in the nearer future. One other thing is that it was brought to our attention. It was brought to our attention that there are some possible residual funds from the bond that once the whole project's completed, I think soon, that there's going to be an amount somewhere between 65 and 75,000 that will be allowed or be permissible to use toward the debt service, and that I would recommend that that's what it be used for. So the recommendation is this debt, what I'm just calling a debt service user fee, to be reevaluated. It can be reevaluated in 5 years, and but at this point, at 2350, it would cover the full amount, or 99% of your debt service for the year, and the other can be paid out of operating.
So this would be added on to each person's water bill each month?
Yes.
$23.50,
Yes.
so instead of being 30, it'd be 53?
Yes.
Now, we do have some water bills, or I know some people have a meter strictly for irrigation purposes.
Not including those.
So
Not included.
those would not, so they won't be double, it'll be.
No, it's just
basically
like
per
what's your
household.
main bill.
Okay,
Some of them, but some people get $3. I don't know what that is, but so it's just your main bill. Okay, so the other part, again, we're going back to the other part, is the operating shortfall. So we're also recommending a rate increase.
This is gonna be really popular.
Yeah, I know, but we'll just walk through and, so your current is, it's actually a half a cent. This was supposed to be changed. It's a half a cent per gallon, which comes out to your minimum bill is $30. Or actually, this is wrong too. You can get it changed.
I didn't change all the pictures, changed.
Okay, in your book
Yeah,
it's changed.
it is.
It's supposed to be 006. So this is the total, and you're supposed to split it between. So it's 1 2/10 overall, 0.6 of a cent for each one. So your minimum bill would go up to $36 for just your usage, and that would generate about $50,000 if you're basing it on $25 million 25 million gallons sold. That fluctuates. Sometimes, some years it's 28 million, some years it's around 25 million. So this additional revenue will fluctuate, but it'll cover the shortfall, and you'll build your fund balance.
Charlotte, you mean that if the $36 is the minimum, or from 30 to 36?
Plus the 2350. Yes, ma'am. Now,
Water bill's still basically stuff.
now, a couple of things. We're gonna walk through the debt service issue.
When was, let me ask this, when was the last time we raised the water?
We don't know.
Yes, we do.
Okay, so,
It was 2008.
okay, so,
No.
so we're gonna go forward a bit since we mentioned rates. Well, I'm just going forward.
But the question came up, you found that's where they approved that in the minutes, but I don't think Kimberly or you or anybody's been able to actually determine that the rates went up in 2001, because
But I wanted to
it
say
seemed, 2008, I'm sorry, because it seems strange that maybe the rates went up 5% or something, it came out to an even penny, or an even half cent for each side. But do we know that for a fact that it was actually implemented? That's the question.
I haven't had conversation with them.
I know, and Kimberly looked and she couldn't find that it was actually implemented.
It's just, you know, I've been here, but I haven't.
But it really doesn't matter.
Okay, since we're talking about the rate, then we're gonna skip the bond a minute, and in your packet, I had, looked at the,
It says it's been updated, the rates of 2000.
you have a couple of, items that deal with rates. You have, Kim called around to get what some rates were because I had gone on to the Texas Water Board or TCEQ and got, there was, you can, Texas Mutual League, Municipal League, and you can look at rates, and you have the information in your packet. But this is what, Kimberly had, done, just to get an idea how the city compared to some of the other municipalities around. And so she was able to call Beaumont, China, and Sour Lake. And, you'll see that, really you wanna look at probably China and Sour Lake, because they're about comparable, but, they're, for 3,000 gallons in China, it would cost you $64. In Sour Lake, it's $38 rounded. Okay. So that's just a kind of it's just a way for you to judge where the current rate compares. You have a little one-page annual wastewater and survey results. You can go online. It goes all the way back to, it goes further back. I just stopped it at 11. But if you, what they do is they survey all the cities, and they're large cities, little cities, all 641 cities. But just what struck me is just going from, if you look at the increase of water usage from 2011 to 2016, there's a 24% increase in the rates. It's gradual, but over the 5 years, on average, water usage went up by 24%. And wastewater services went up by 15%. And again, we're assuming that there was no rate. Do we know if there was a rate? At least 2008, there's been no rate increase.
According to their minutes, it said, that the rates that
They
the
approved
rates
them,
and fees for the districts, have been updated, so.
but that was when it was still Beaumont. Okay.
That's the last, it has not been since it's been the
The
city.
point is, y'all should have been raising your rates a little bit, at least every 2 years. Because you're not keeping up with, y'all haven't been keeping up with the cost of living. 3 to 4% every year, or every other year at least, over a 10-year period. That's anywhere from 15 to 20%.
I know y'all spend a many an hour working on this, but is there any place that we could make up some of that money without going up? That's going up like 50 cents, been $30.
Well, this is the best option because it fully covers your debt and it starts building your fund balance. I wanted to present one option and walk through it tonight, give y'all time to absorb it, and there's not a whole lot of options, but, you know, we can always come back with maybe 2 or 3 scenarios. But this is the best option. This covers your debt and it starts recouping the fund balance that y'all have used over the last several years. And it's gonna continue to erode to where you don't have any fund balance, regardless of even if you just took care of the debt and didn't do the rate increase, you're gonna start eroding continue to erode your fund balance. And your debt will be covered, but you won't be covering your operating expenses. So that's why I say it's a combination of both the debt service and and the fact that y'all haven't raised rates and y'all owe long overdue. Yeah. So this is just for y'all, there's just a couple of pages of information on rates, just to give you some background and give you some information to try to, reconcile to what's happening outside of the city and what the city has not taken care of as far as the water department. Okay, so I must try to get out of this and go back to the debt. Do y'all have any other questions on the rate? I mean, other than how we can not have one. So, let me see, I hit escape. And then I go back to, should be photo 8. Photo 8. So I go down now, over. Okay, so, we're back to the bond. And there's two of these in your packet, the tax revenue and the estimated utility system cash flow. And these reports were initiated by Mr. Gilly based on information the city provided him at the starting point of the bond discussion and walking forward. So I think, as far as I could tell by emails, the whole bond discussion actually started kind of back in 2013, or it was a long process. So, but this is the initial cash flow projection based on the audited financial statements from 2014. So he was doing this I think it's actually early 2015 when we got this report. Actually, it was report says dated March 9th. It was in my emails. This information where it says for fiscal year 2014, this information, the 334,000 revenue, 377 expenses, those are straight from your audited financial statements. The calculation of your net cash flow based on those historical numbers was a negative 42,000. We add back depreciation because it's not a cash transaction. And then you see this added cost reduction estimated by city, 161,000. Those were the figures that at that time between council, Kimberly, all of us looking at the city would save, instead of, if they went with the sewer system, the sewer contract with Beaumont. So you ended up with an adjusted revenue, and he's taken out a transfer to the general fund. This 24,000, that's the debt, that's the bond, the Badger note, that was the debt we had at the time. And then this 179 is an estimated charge from Beaumont for the sewer contract. So on this original cash flow that he sent us, there was a negative cash flow of $12,000. And my email from Becky was saying, help, this doesn't make sense. And so at that point in time, Kimberly and I, we were looking, it makes perfect, this is the calculation. But at the time, he was using historical numbers. So we had correspondence going back and forth where we actually, and I sent, we recommended that this number was actually going to be around a positive 25,000, which is probably, pretty good. And that information was, I don't know in what form or fashion, because I don't have all the correspondence, but that's the information we provided to Mr. Gilly. Okay, so this is the 9th, and this is what's happening. I think y'all had you had a deadline to be able to approve the bond, and so, again, this was March of 15, so you're gonna have, I don't have all the answers to what happened, what didn't happen. I'm just trying to lay it out for you. So this, the second one that you have in there is the final one. Hold on. Let me see if I can figure 9, right? Okay. Okay. So in between this one, which is the final one, there was another cash flow that was, that this was the same, but the percentages were different. We were still dealing with the 2.8 million, and in between that projection, the first one, and this final one, we ended up with 162 positive. But when we were going through our budget and getting to the preliminary budget that we were going to present, there was obviously a disconnect, and so Kim pulled this out. We were looking at, how can it be? Okay, so if you'll notice that this final cash flow projection is based on 2015 revenues, expenses, and net revenues that were estimated by the city. So this is what I think happened. I mean, I know why the number's wrong, but what in the final, he was given revenue, which is about what it came out to be after the year was over. And then he was given expenses of $238,820. That number has the reduction for the savings of the sewer contract already taken out of it. And then it was added back again with this 171.44. So the add back for the depreciation's right, but because the reduction was in the expenses that we already, I'm assuming we gave him these numbers, or he calculated and stuck it in there. I don't know what happened. But this part, this 170, been zero. Because this was not gross. This was not gross expenses. This was with the savings. This was with the expenses taken out already. So when you do that and you walk it through, you've got an inflated net cash flow because there was a duplication in a reduction of expenses. So if you walk it through, then you're back to, you're really back to the minus 12, which based on these numbers is, again, not fully accurate, because I do think that at the time, y'all ended up with about $25,000 in net cash, so I don't know what happened. Why we even had the net 12,000, the negative 12,000, because all of the information that we have between Kimberly and I, we both ended up with net revenue. So, but this is why we have the deficit. Because we didn't have the 162 to cover the debt. And this 162, he's calculating this cash flow here, this 162, that is both the bond and the Badger. Because if you look at 2024, your cash flow increases to 186. Well, that shows that the Badger's being paid off. But again, you may not have 186 under this scenario. So there's a flaw in the cash flow estimate at the time the bond was approved.
I have a quick question.
Again, that's just
Looking at the first sheet, it looks like on March 9th of 2015, it was already anticipated, based on that right-hand column, that there was going to be additional required per connection per month of $24-25. If I'm reading this correctly.
You
So
are.
that was anticipated
yes.
already, so this additional connection charge is not a surprise.
Well, it
Well-
is.
Well, it is the fact we thought we had the money.
We thought we had covered it, but initially,
But really, it was.
from the get-go, from the beginning, it was already planned,
You're
this
right.
is what was gonna happen.
But then, as it went on down, we thought we were getting better.
Saw the
That
second
it
set
wouldn't
of
be
numbers
as
and
bad.
thought, we're good.
Yeah, you saw the second numbers, and
Yeah.
instead of needing a additional required per connection per month, it went to cash flow. We had a positive cash flow of $50,000 at the bottom of the page.
Yeah.
So,
That was a heck of a swing from one way or the
So
other.
we were-
But we
we
thought we
realized-
were stepping in high cotton at that time.
Right.
excited that we might have just very little that we have to do. So this was a
And
big
then-
shock.
Beginning numbers, the first set of numbers
Oh,
was,
yeah.
Really, we're correct.
was the correct set of
Yeah.
numbers, the
And-
second
and-
section never.
And I don't remember, I don't know that I was involved when I don't know if I was here when Mr. Billy came or when y'all voted on the bond. I know he came once.
He came several times.
Okay, so I don't know the process of him showing these. I know these two, were within a couple of days.
Really?
Well,
Yes.
the second one,
Well,
this is
I'm
the
sorry.
one that was generated after the bonds were sold, and we knew exactly how much the interest rates are, because you'll see they varied there 2% for a while, 3% for a while, 4% for a while. Whereas the original one, he was just guessing at an
Right.
interest rate of 3.75 all the way down the page.
Yes, but on that, so we got, but we did get,
We got the
between
two.
the 9th and the 10th,
We got the 2%.
this changed.
Right.
Yeah, somehow.
Yeah, but our bonds.
And it still didn't match what we calculated, so.
After he sold our bonds, he
I
came
can't-
back and did this at the 2%, because that's what we actually got. Because since we'd never had a rating, he didn't even think that we'd get anything better than three
And
quarters.
and originally he had, originally on all the projections, the actual par value was 2 million. And and your actual total cost was 2.8, depend on the final, like you said, the one that was approved, this one, it's 2.6 with the rates going, when we adjusted the rates, it actually, there actually was a decrease in the projected interest overall because of the rates. And the actual bond was about 70,000 lower than the $2 million. But again, if this is where the error occurred, this would have worked out. I mean, we would have been where we realistically should have been if the expenses hadn't been changed.
Well, it looks like he was working with actual 2014 figures
Well,
initially, and then
yeah.
estimated 2015 figures
Yes.
the second time.
But it
around.
had to been through February, because this was March, so he probably provided, year to date.
And then he-
But we also probably, the city, subtracted the benefit.
Right.
And then it got added back again. So, it's.
So in essence, from having $162,000 to spend on debt service, we're actually short $171, so that's just about the difference in the
Yeah.
whole shooting match right
And
there.
between that and the interest rate, that's where.
Yeah, but again, yes. So we have two parts that we're dealing with. The debt service, that's not covered. And also the deficit in just your operating,
Yeah, that's.
If I'm understanding her correctly, just with 1 month of actual looking at,
well, it was
expenses,
probably October 1 through February 29th.
I'm talking about for right now, that,
Oh.
I was about to say that with just us having 1 month of actual activity with Beaumont, unless
Oh, yes.
unless at the end of next year, we can look at all this and things significantly change. There's not really much else you can take off of this budget, because this is all we have to work with. We had hoped that by the time we got to this time, that the thing would have been up and running in maybe 6 months or so, but with that delay after delay after delay, and so we've only got 1 month to show for it. So it's kind of hard to figure what a year's gonna look like with 1 month. So we can hope that it won't be, this bad, but you don't know,
Well, expenses have gone down across the board.
Well,
I
it
mean, when you
has.
look at them, we're cutting expenses.
We are, but I'm just saying,
Across the board, there's really not.
unless if we got just really lucky and they weren't as bad as we're anticipating them to be, then that's the only thing you can hope for, is that at the end of this time next year, that they would not be as bad, but they may be worse. You never know. The well might go out or something. There's just no telling.
You asked earlier about
I don't want to do that.
did anybody have any idea about what could be done other than not doing this?
So,
What about the city picking up some of this?
well, what I want to do is that, there are,
I mean, is that
I'm
legal?
presenting it, yes, but there's not a whole, the city's fund balance, it
We don't
only
have
has
enough
the.
to pick up in the first place.
The city only has so much in their unrestricted, which it's available, there's no municipal code, or there's no, local government code that says the city can't transfer money between sides as long as those funds are not restricted for any other use. So because we did that, we do that now in the sense that the water side transfers money over to the city for like the payroll, because all the payroll is paid out of the city side because of just the logistics,
So you don't have to have you
but.
don't have to pay for 2 different accounting systems.
Yeah. So those transfers happen, and yes, if there were funds available in the city, and the council decides some of those funds could be used and for anything in the water. It's just a matter of council saying, okay, yeah, I want to send 25,000 over the water and we're gonna use it to pay debt service, or we're gonna use it to offset our operating deficit. It's fine, except it doesn't work long-term, because now you're draining, if the city side's not making enough money and growing its fund balance, then you're just draining their fund balance to
And
prop
you have
up
to remember
the.
too, that the city is
water.
funded by tax dollars. The water utility is funded by user dollars.
Yes,
So it's fairer to let the user dollars pay for the water, because that takes care of everybody, and then you put the burden
the
on
water
the
department should
taxpayers.
stand on its own.
Well, and to make any significant dent in that $23, I mean, we could cut it in half. If we cut it in half, we'd have to come up with 75,000 out of the city budget, out of the city, when our annual operating budget
It's
is,
200,000, period.
it's 220, 225, so there's just,
We've got a ditch over here proposed for how many thousands, 60-something thousand dollars?
No, 45, you keep saying that number, but that doesn't make it right.
First time I said it.
These are some of the things that council is gonna have to talk about and come, and, I mean, and
Well,
I can provide you guidance and suggestions, but as part of your budget for the water side, y'all are gonna have to decide what you're gonna do, so that you can, approve the budget. And y'all have time to have some discussions.
It's
You have
gonna be
some time.
hard, it's gonna be a hard sell to tell somebody that they're gonna have to pay,
I understand.
an extra $12.50 so we can have a, landscape ditch over there per month.
but they're not.
Right,
That has
Here's,
nothing to do with it.
here's the thing though, but here's the thing.
$25 ditch.
We're looking at $156,000 a month. The city
Look at
budget.
how many,
Well, that's a year.
No, a year.
No,
Yeah,
not
it's a
month.
year.
Is it here?
It's a year, okay,
So,
so.
yeah, we would, y'all
It's a
could
year.
close
I'm
your
gonna-
door if it was.
But, I mean, we're looking at a tremendous amount of money
Yes.
well,
for a year.
no doubt about it, but we're only looking at $23, what is that, $23.50?
If we make it just, what are we gonna say, $3, $5, is that a significant enough
Half of it.
impact? If we took a third of our city's operating budget and put it toward that, a third of our overall city operating budget, that's
You can look at it, there's a lot of ways. to look
This
at
is
it.
just.
Okay, well, this is, what I would like to do, I have one last piece. And then we can, and then, yes, this discussion
Sorry.
kind of begin. And it really is, I mean, I'm not being facetious or anything, it is a serious concern. I wanted to, at this workshop, I wanted to be able to provide the very best option. And then you can decide if you want to tweak it and how you might want to tweak it.
Your hands are pretty well tied on these now.
But-
Because you just gotta make, you gotta have so much
You
money
do,
to
but
pay this
it's
off.
how you get it.
Yeah,
How you get it and how much you can tolerate shoving further down the line.
I asked the question, was there, after so many hours that y'all spent, was there any place that we could, save on? And the only thing I can come up with is dues and subscriptions, and that's just $750.
Some of those things are not,
And
it's not a subscription, I think those are dues. that you
So I
have to
think
pay.
I think if I would have provided you with like a P&L for the last 5 years, and you would see the expenses and how, you would see them actually going up a little bit, but at the same time, some of them are real constant, you know, your fees are the same, but it's your maintenance, repairs, your electricity, things like that you might see go up. So the last, so, you know, those are things that we just, those are things I looked at when I was looking at, you know, how do we budget for that? So, but the last 2 pages are going back to the budget and showing the effect of the proposed revenue generated. So your last 2 are, the last column is proposed budget with fee adjustments, which is the 2350 and the 0.2 rate increase, which is a 20% rate increase, which is 20%. Okay, so it would, so your water revenue and it's, again, it's based on it's a rough estimate, it's based on the sale of $25 million, 25 million gallons, which that fluctuates every year. This could be a lot higher, it could be a tad less, but I think 190 is a pretty good, it's a conservative estimate. We're adding $25,000 to water revenue, your fees stay the same, and $25,000 is added to your sewer revenue, which brings your operating revenue to $379. And then I'm calling it your debt service monthly fee. It's got $155,100. That's an estimate. No changes on your expense side. And then, so if you look at the second page, which is this. Okay, so if you look at the second page, just by generating the revenue, you now have a positive almost 26,000. Which means you paid your debt, you covered your deficit of your operating, and you brought 26,000 into the next year, which replenishes what you used in your fund balance in the prior year almost. But you're building that 25,000 is not restricted. Some of it may end up being restricted because you may still have some left of that 155. But for the most part, you're putting $24,000 in your unrestricted fund balance.
Not only are we operating at a deficit for the 2015 fiscal year, we were operating at a deficit in 2014 fiscal year that was even larger. It was at 42,000.
But what we're not seeing here, even if you don't change anything and you don't accept this and this is how we come out, okay, this number is your budgetary profit and loss. Okay, but when you go and when we do the year-end adjustments and prepare your financial statements for your auditor, this number will be higher. Well, it might actually be the same, but we're going to take this number. Here's kind of a mathematical walkthrough. We're going to add $75,000 to the net income because that's the principal part of your debt. That's going to go on your balance sheet and lower your liability. Most of that $23,984, which is your Badger meter payment, it's going to increase your net income, just say by $22,000, because it's going to go over to your balance sheet. So we've already added 97,000 somewhere in there. So we're looking at plus, but we don't have depreciation in here, which is about 100,000. So you're actually probably going to have less than that on paper, but in real dollars, cash flow, 25,000. Because your budget, because the financial statements that you see every month is on the budgetary basis, and we don't book depreciation. You're kind of seeing cash in, cash out, and that's how we're budgeting for it. So when we look at the budget this way, we're really just kind of looking at, okay, these are our revenues, this is what we're spending it on, and then the accountants tweak it all at the end of the year. But you're actually, under this scenario, you're actually bringing in $25,000 more dollars.
Charlotte,
Yes.
I'd like to point out that, there's $25,000 extra or positive that you're bringing in. That's based on this 2350 fee and going up 20% on the water and sewer rates. Keep in mind, no question, this is just going to be natural. People are going to start using less water. If we sell 2 million gallons less water next year after this goes into account, that's gonna stop us from making $24,000 in revenue. So that will be a break-even number, and you can't make it at a break-even. So the only thing I'm pointing out is we can't scrunch down so tight on these numbers and make them so cheap, or not so cheap, as low as possible,
Less painful.
without having, less
Less
painful, that's a better way.
Yeah.
And bring this net revenue down any more than this. This is probably too low like it is, knowing that people are gonna conserve water and we're gonna sell less for at least a year or two. Historical data from around the area and others shows that, after you have a major increase like this, people stop using as much water, but in time they go back to their same ways. So, but you don't know how long it may be. It may be a year, maybe 2, maybe 3. You can't count on that. So what you have to count on is we're gonna probably take in a little less than what we're projecting with these numbers right now. Just to keep in mind.
It will be very beneficial if we have a year's hindsight.
Right.
Because some of these, like I said, the revenue projection, just because of the rate increase, we don't really know how that's gonna affect people's usage. And it may be a dry year, it may be a wet year, and, so, but if we walk through a whole year, it'll give us a better idea of how to actually project it. And again, the fee, the $2,350, that covers the full debt. 5 years from now, the city may be doing, the water department may be doing great with just the rate, and you might be able to reevaluate that. It's not set in stone for 20 years. It's kind of like set in stone if you want for 10. It is set in stone if you want, at least for the next 8 years, to make sure you're covering all your debt. I think that's what we have left on is Badger.
Yeah, 8 more after the payment.
And the thing is, if in a good year and you do have, if you're satisfied with what goes into fund balance, I would say pay early, pay on the Badger note. So if you're paying off some of the debt, then at that point, you know for sure you have the 132 until 2035. Those are gonna be hard to pay off, but early, but you can, it's easily, you can probably pay on or save to where maybe you can pay extra on Badger note and accelerate that, pay it off, and then you can look at lowering your debt service payment. Because that is, if you approve, whatever amount you approve for the debt service, it needs in the verbiage, you need to make sure it says it's restricted for debt service. And any annual residual is restricted for future debt, for next year's debt. So it can't be thrown into the general operating account and used. It needs to be reserved, and that way you'll build it up.
As with other loans and things like that, we can pay additional to the principal without incurring any penalty.
I think you can do
We incur a penalty.
Not on the bond.
We will incur a penalty on the bond.
But you can
But you
can't do it.
can't do it.
You
pay
can't
off
do
the
it.
Badger meters.
But
That's
Badger, we can.
Yeah, and that's what I'm saying, pay off the Badger. I'm sure they'll let you pay that one off.
The form says not the first 2 years, you don't have to pay that off, but
But
after that.
after that, you.
Well, you're already,
And
this is
we've
your,
got our check ready to go for the second pay.
is this your second year? Okay, so, and you'd be surprised if you just throw little chunks at it. Now, yes, sir.
I'd like to point out as tragic and as whatever is this news is of these numbers that we're faced with, the most tragic thing about it is we didn't know this last year, because had we known the real figures, the real truth last year, we would have had this discussion last year, and put this into place, knowing we're behind the 8 ball, because now we're behind a year in doing this. Now, we have to hope and pray that these numbers will collect us enough money to pay our bills each year, rather than having the money in the bank already from having a year. So, like she says about having no historical data, it's a double whammy that we don't have any
Yeah,
historical
and
data.
whatever residual dollars you have left from the bond, I would use that to open the interest in sinking, a separate interest in sinking checking account. And, it could be that if there's months where you have excess, if you have some excess dollars, those funds get transferred to debt service. You know, it can be a little bit, it can be 1,000 one month, or 5,000 or 500, but if you can maybe build toward having a year sitting in there. And in case something happens, because normally a bond like this will have debt, what we call debt service covenants in it. I don't recall seeing any, but normally the bond document will require the purchaser, the borrower, to set up what's called an interest in sinking account and actually fund it with the next 12 months of annual payment, principal and interest, and always have that amount in there. Not build it up and use it, but always have that, get to that amount built up. Usually it's within, sometimes it'll be 24 months, sometimes they'll let you do 60 months, but the goal is you always have a year's worth of principal interest payments in reserve in case something happens, that you don't default.
We'll never have that now.
Then what happened? Why didn't they tell us this?
Well, she
But,
just showed
well,
you
what
where
I'm
the mistake
saying
was
is,
made.
what I'm saying is that the bond may not have that requirement. I don't think the
I don't
bond
recall
document.
reading
No, that's what I'm
anything,
saying.
no one has told us that.
I think I read it.
don't remember.
Normally when you have a private, and y'all had a private
Right,
purchaser, one purchaser,
right.
so you won't have that requirement. But it's not, but it's still a good thing.
It's a very good idea.
It's still a good practice, so, but that's what I'm saying, you have, whatever residual monies you have from the bond, you should take that money, even if you end up using it, at least open that account,
We're gonna use it, we don't have a choice. huh?
and then,
But the person we used, why didn't they tell us
Well,
that?
he thought he made a mistake in the numbers. He
There was-
thought he had the
yeah.
right numbers.
Yeah.
He didn't know that he wasn't telling us. He thought the numbers were correct.
and I don't
I
know,
mean, looking at this, it looked like everything was okay, sure. I mean, I'm sure he didn't intend to give us something with an error message.
and he may not even, I didn't talk to him,
He probably doesn't even know.
he probably doesn't even know it. You know, because I didn't see any sense in talking to him, because you can't go
There's nothing
and
you can
do
do.
it.
You can't
It's
do it.
been a year and a half. He won't.
Yeah, and being that far away of it, we tried to kind of walk it through and try to figure out, and he either would clarify or get even muddier, so, but my thought was, it can't be undone, there's really nothing that you can do, the bond sold, and we just have to find a way to cover it.
Well, as
And-
Michelle said, we thought at one point we were gonna have to do it anyway, and we knew we weren't gonna get away with this free. I mean, nobody, I think, ever thought we were gonna be able to do this without an increase.
I would
We just,
I would hope that maybe even if you were in that same, if you had the right information, that the likelihood of you having to
It
still
would've
do
been
it.
Well, we
You
worked
would
so
still-
hard to keep from raising taxes.
yeah, we have, but, when it comes to it, we have to do what you gotta do.
Raising taxes, where's that coming?
Well,
Our tax
Maybe,
rate
she's
dead.
talking about just making
In
people pay
general,
more
in general, we try
Try
not
not
to.
That's in taxes, this is.
No, we try not to increase anything to anybody. Right, but, you know, when you
But
can't
that's
do
not
what you have to
necessarily
do
prudent.
without doing it, you
Tax
can't
rate
do
going
it.
up every
Yeah, so,
Yeah, but I mean, we have tried not to increase these tax rates. Make,
are there,
we
are
have
there
tried not to tax the people. We tried not to put an extra burden on the citizens.
But her point that it's not prudent is correct.
That's
We-
exactly
we-
right.
The
But
water
by,
part should never have been.
by avoiding any increases and trying to keep those rates and those taxes at 8 to 10-year-old numbers, you're doing harm on the flip side. Because you're not keeping up with your expenses. And on the, maybe not so much on the city side, because like you said, your rates go up, your valuations go up, but on this water side, consciously not raising your rates for over 8 years, that's not good business. And saying that, whatever rate increase y'all decide on, the city council should be looking into, no less than 2 years. And it's a little bit, maybe a 3 or 4%. You're just keeping up. It should be reevaluated 2 to 3 years. And not every year, that would be. But if you're living in a reflationary time, it would be every year.
And along the lines of what she's saying, I don't know if any of you here saw in the Beaumont Enterprise last Wednesday, Kyle Hayes, the city manager for the city of Beaumont, said that, they were going to be looking, he was going to recommend to the council to raise water and sewer rates in Beaumont by 3%. Well, that affects us because we pay outside the city rates. That's what this $168,000 expected expense is. So if they raise rates 3%, that $168,000 is going to go up 3%. If that's a true number, whatever that number is, it's going to go up. We're not going to know for a year what that number is.
Is
But
that number gonna fluctuate based on
Water use.
usage?
it's per gallon. It's
So
per-
we may be in a high month. Is it based on your water usage? The sewer is based on your water.
That's right.
Correct.
Even with Beaumont.
Of our primary meters, not our secondary.
As far as this calculation of the
That's
sewer
right.
expense, okay. So historically, these next 4 months are your highest water usage.
The next one.
If it keeps running,
Now-
it won't be.
No, now, but I mean, normally, September, August, July, June are your
Yeah, back
highest
in
months.
June, yeah.
Yeah.
Yeah, I agree with that, but not from now, 4 months.
So what you
Yeah.
might see is that 106, whatever we paid, 13 something, 14 something, it may be 11 or 12 in January, February, so
Okay.
we don't know.
What's the benefit to having a monthly user fee over just putting it into the water rate?
Well, you probably, we have to calculate what your increase would need to be to generate $175,000. And it could just be one time rate on your water. You'll have a little bit more fluctuation because of usage, people coming and going. But you might have to have.
It might have
I
to be
think,
more.
I think it's more transparent, to be honest, if we just have it as a fee and designate that money.
Well, here was the
It
other
goes to
thing.
designated funds.
It penalizes your higher users. It does help your lower minimum users,
A lot
which,
of the people that use the minimum out here, are probably, I'm guessing, I think, I'm not gonna say that historical data and all that, I'll tell you, but I think it's a lot of the, retired, We have a lot of widows that live out here, we have a lot of people, I
More
think
people
that,
you wanna get rid of.
No.
It's the more people you wanna get rid of.
yeah, well, they're going away. But
Well, yeah, I understand what you're saying.
what I'm saying is you're gonna hurt those people more. You might think it's funny, Dave, but you don't even live out here, but,
Which what we can calculate that. We can calculate what
you're
it
gonna
rates.
you're gonna hit those people hard as to where the people with dual incomes and stuff, you know.
You might have to raise it, you know, we're doing 2/10 of a cent. You know, we can calculate a cent. We can give you different calculations of just a one-time big rate increase.
Well, then you would have that built in for later on
Yes.
also.
But how are you going to, how will you,
Your
That's
minimum
that's
might end
your
up
debt.
being,
That would
But
carry
it's
it
on.
don't matter, huh?
no,
Pretty balanced.
no.
Okay.
As long as your total revenue
After you
covers.
pay that back,
Total
thing off, you'd have all that left
Yeah.
over, you know, and it wouldn't be sticker shock again, you wouldn't have to go back and do that, that would build right into your balance.
I bet that's
In
the
your
way they were
operating
doing it.
balance,
I
you
bet
have
that's
to
the way
build
they
your
were doing it when
operating
we
balance
first
up.
moved here. when we
You know,
paid
you-
$25.
It's inevitable that the worst thing's gonna happen, you have to redo your wells and stuff.
So it's something to keep in mind, the way that she has suggested, and I'm just pointing this out, everybody might not feel this way, but by having this user fee, whatever we decide it to be, whatever the number is, you know, that spreads that cost evenly among everybody. Everybody uses the sewer system, it's a benefit to everybody. I understand his argument that it imposes maybe more of a hardship on the fixed income people. But just like when the water plant was built and they imposed that $25 fee for 25 years, that's a benefit to everybody equally. It's spread equally throughout the community. And then on top of that, the people that use more water with this rate increase will pay more money. Now, something to keep in mind, I'm just pointing this out. If you make the water rates really high, you're going to really make people conserve water and do the opposite of what you're trying to do. You'd be surprised how many people we have that use 10,000 gallons of water a month, and I have the list that Kimberly gave me right here. You'd also probably be surprised to find out that this past month, we had 180 people that paid the minimum water bill, $30 a month.
It's around 200, it's around between 180 and 200.
What might be interesting is if we did a hybrid, and I would be interested in looking at those numbers possibly. If we did a hybrid of a fee that was lower than the $25, and combined with a larger increase per gallon, so that it was less of a burden on the fixed income. They're still paying a user fee, but if we balanced it a little bit, so it's not all user fee is paying it. Part user fee.
Well, so
part-
we
part
can get her to
fixed,
figure
maybe a
anything.
hybrid.
What are you thinking for a monthly user fee? Because she can figure anything. All we gotta do is give the parameters.
$12.
Okay.
Ooh, you're gonna be surprised at
I'm
what
just
the water bill's
curious,
gonna
I'm just
be.
curious, we cut it in half, and let's just look at it and
Okay.
see, because there are a lot of people on fixed income.
You don't,
That is right, and that's what's-
I
I
totally
don't want
disagree with Mr. Frugier that you're spreading it around to all the people. I mean, some of these houses have 5 to 6 people living in their houses off 1 meter. If you do it by the meter, you're charging this one person that much money, yet these other 5 people, it's split up between 5 people that are using it for water at the other house. You don't see that.
5 adults, or are you talking
I
about
do,
families?
but like I said,
Three.
the
So,
Yeah, you're talking
how
about
many
family,
families do you have with teenagers here that
Yeah, so, I mean,
they
you
take
got
showers
Oh my
every
gosh,
4
my
times a day?
13-year-old
long,
is still-
long.
I got one.
So you're saying don't put a user fee, just put it on go up on the water itself?
I'm saying that would help the fixed income people out here. That I don't, that y'all
We
say
could
that
see
I
a
don't
hybrid,
like.
it could be about
Although
$12
I-
to
You
$15.
know, there's gonna be pros and cons for both, and I'll just play kind of devil's advocate a little bit. If you did just the pure rate, which I don't know if that would work very well, but you might do a hybrid.
Something.
If you have,
It's
your
half that
higher
much.
income people and the higher users, they're months are they going to gripe about it? And then it just becomes part of their monthly expenses.
Or
Because
anything
they're
would
not
change.
gonna quit, because
Anything would change.
I can see if somebody's watering their grass or watering their yard, they may quit that, but if they're.
But we
but if
have a
they're
secondary
using
meter for that.
in-house usage,
Yeah,
they're
they're not gonna
not
stop
going
doing
to
their laundry, they're not
minimize
gonna stop
Yeah.
washing their dishes, they're not gonna stop.
You're gonna be looking at the people that like have beautiful yards, they may
No,
decide.
but you have secondary meters for those things, they're not gonna get charged on
We have
that.
secondary
Okay,
meters.
so this is just inside usage.
Yeah.
That the bill is, any watering, it has a separate meter.
Some, majority of them.
Most
There's a lot of separate meters that they do the lawn.
Okay, and we're not,
That's still gonna
is
go
that
up
the
though, right?
$24.95 flat?
Yeah.
Water's gonna,
But they won't be
the rate,
charged, they wouldn't charge them the.
The water, they only have the.
but it'd go up proportionally, you know, half of that.
Almost 30.
Well, I mean, I can calculate whatever y'all want me to calculate before and get it, and send it to Kimberly, and she can disseminate it, and I'll even be happy to come back and, talk about each.
Well, why don't you just do that? Why don't you do one like Michelle's talking about, do one that's just
Probably
strictly for water bill?
$15, make it, and
I can
seems
do,
reasonable.
I can do the extreme where
It's
we
just a what?
need to generate 180,000.
Yeah,
Well, if you want to build your fund balance, if you want to build your fund balance, we want to end up with net income.
We have to.
So you have to tell me what kind of net income you want
so
to
then
end
you're
up
gonna
with.
have to find 200,000 then.
Yeah,
Should've been
so,
80.
but what I'll do is, since this is the budget that we're working with,
Just like that,
we're gonna find a way to fund it just like
just
that.
like that,
Yeah.
yeah.
And then you can just,
And maybe if you know, I mean, instead of having to go up later, I mean, if you go up, you still have to go up a little bit later, but if you split it, or if you put it all in there now,
it's
then
done.
it's done.
Well, I don't know about going up again, though.
No,
We're
it's
gonna have to
so like I said, maybe in a couple of
But you-
years.
Every 2 years, we are going to have to increase our water rates. Every 2 years, we're going to
But
have to.
it's like at that point, it's a couple of dollars.
The
I
most
mean,
beneficial
you're
way
raising,
to the-
10 to 20,000, to cover your increase. So,
Well, there's a lot of things like this happening. I just got a tax bill in Tyler County that they're doing it 30%. On their taxes. I mean, this is the land. value.
Exactly, because other
And
government
this
My
is
land
all-
taxes
getting
went up
Yeah, and just a couple of years,
150%.
a couple of
Yeah,
years ago, all of our land doubled in value.
They didn't raise your rates,
Yeah,
they increased your valuation.
property value.
For this
well,
year,
that's what I'm saying. That's,
now they'll go back to
yeah,
ground.
it all grows out in double, in value, which increased, what we had to pay. So, I mean, things like this happen. They have to catch up because they hadn't fooled with the land values out here, and you can go back and look at that like 15 years or something,
Well-
So it does happen.
I know it's gonna be hard, I know it's gonna be a hard, painful issue to address. Especially since it was based on a mistake now versus we went into it knowing exactly what we were dealing with, and we would have already been a year past, we would have been a year past it. But the debt is an issue. But I also want y'all to put the proper importance on managing your rates.
Right.
And when when you do get the feedback that you're gonna get, or that's probably a kind word for it,
Very kind word.
you have to remind them. You have to remind the citizenry that you have not had a rate increase. At least since 2008. Could have been more than that, longer than that.
I think